sitting with a profit and you're feeling pretty comfortable. But now as the price goes up farther and farther, you're looking to salvage some profits. You don't want to wait until price comes back up here. If you entered here, you sold short here, and price makes it down here. When price starts to move up, now your profit is being eaten away. You've already spent that profit. So what are you going to do? You're going to buy back. And everybody in these bars are doing the same thing, either to salvage their profit, either to break even, or to cut their losses short. And all of this short selling is what actually causes price to spring back up. And some of you may have heard the term. Many great historical traders have made the phrase, buy when there's blood in the street. Let's say that these bearish bars, they're red. I have them black here, but they could be black, red. They could be any color that you choose on your chart. But many people make them red. And let's say that if they were red, and this is the street, George Soros, Buffett, Gann, all of the great legendary traders. This is a classic timeless market term. Buy when there's blood in the street. And all of these red bars, this is the street, and this is the blood because they're red or bearish. That's why you want to look to buy when there's blood in the street. Because it's the blood, the death blood of these short sellers that allow you to profit. But now once it starts going up, and once these short sellers all sell out, now we have a bullish bar. And what did we say about a bullish bar? Who are these people? They're buyers, right? If they bought here, they're in a negative position all the way down here if they did not get out. What are they doing when price is falling? They're hoping. See, this is what is meant in these these same classic traders. This is another timeless phrase. Markets are built on hope, fear, and greed. Because these people who bought long here, they don't know if price is going to come back so that they can sell once it gets back to their entry point. They're hoping price comes back. And the people who sold short here, and when price comes back up here, why are they still here? And see, that's where the term greed comes in. And once price goes above here, why are they getting out? Because then they'll be in a negative position. Loss, fear of loss, that's pain. Markets are based on psychology, and human psychology is based on pain and pleasure. These are the two ruling factors that create all of human motion, the psychology of pain and pleasure. When you're in a negative position, that's psychological pain. When you're in a positive position, that's psychological pleasure. Any psychologist or psychoanalyst will tell you this. Pain and pleasure. So knowing where the buyers and sellers are located in a market lets you know where the pain and pleasure is located. And then you can base your trading tactics on the pain and pleasure of the traders who are already in the market. If I'm here and I didn't get out, fear of loss, fear of loss, fear of loss, but also I'm hoping, please come back here so I can just break even, or I can cut my losses are real short. So now this is where you would expect price to stall, stop, or reverse. So this would be your first level of resistance on the way up. The first stop, the first spot where the sellers are sitting. So if you've entered down here, then you would place your profit target somewhere within the range of this bullish bar where the sellers are located. The sellers are overhead. Now, the buyers begin here. You could, if you're conservative, you will place your profit target here. The herd or mass of buyers who are now sellers, they're located at the open to the close. So if you're a little less conservative, you will place your profit target here. And if you're more aggressive, you will place your profit target here at the close, because after the close, that's where the buyers who are now sellers, that's where they run out. And then in the upper shadow is where the short sellers are in this bar. So if price gets up into the upper shadow, then buying once again resumes, because these short sellers are buying back their position. So if price goes back up above here, it's gonna go higher usually if it closes above here, but you don't know that. And once again, the close is important, because operators, market makers, your brokers, they will spike price up above this level to flush out these short sellers that are in this tail, to get them to close out their position. And then price will fall back down and close below the range. And I don't want to belabor the point, and I think you get it now. And now we get into pivot. In the context of a swing, a trend swing, the pivot point or pivot location is the open of the bearish bar. So at the time, once the reversal bar has formed, in the context of the swing, it is called a swing pivot. And let us just go to our pen again.